Imagine a bank vault. That heavy steel door swings open. Inside, stacks of cash, all neatly wrapped, sit silent and still. It's a comforting thought, right? Your money, safe and sound, just waiting for you. But here is the secret no one ever tells you in that quiet room. Most of it I send to there. If every single person who has money in the bank showed up tomorrow morning to get it back, the vault would be empty long before lunchtime. Not because someone stole it, and not because the bank collapsed overnight. It is because the system was never designed for all the money to be there in the first place. This strange, unsettling truth is the heart of modern finance. It's called fractional reserve banking, and once you understand it, you'll never think about money the same way again. Welcome to Behind the Money. We're here to decode the financial world, revealing the stories, the systems, and the power plays that define our modern era. If you've ever wondered about the real story behind wealth and influence, you're in the right place. Subscribe now, and let's uncover these secrets together. You'll never look at money the same way again. To see how we got here, we need to rewind the clock way back. Before apps, before credit cards, even before paper money. In medieval Europe, wealth was heavy. Gold and silver coins jingled in pockets, weighed down chests, and attracted thieves. So people needed a safe place to store it. Goldsmiths, who already had strong vaults for their own precious metals, offered a solution. You could pay them to store your gold, and in return, you'd get a handwritten receipt. This receipt was a promise. You could come back and claim your gold at any time. At first, these receipts were just proof of storage, but then something totally unexpected happened. People stopped coming back for the gold. Instead, they started trading the receipts themselves. A piece of paper backed by gold was just as valuable as the gold itself, and a whole lot easier to carry around. Quietly, paper promises began to replace metal reality. The amount of money didn't change, but how people used it did. Watching all this, the goldsmiths noticed a pattern that would change history. Most of the gold just sat there, day after day, week after week. It never moved. Customers came and went, but they almost never all showed up at once. And that's when a dangerous, brilliant idea appeared. What if some of that idle gold could be lent out? The goldsmith could charge interest, make a profit, and still keep enough gold on hand to cover the usual withdrawals. As long as everyone didn't ask for their gold back at the same time, the system would work perfectly. And just like that, without any grand plan or official approval, modern banking was born. Fast forward to today. The gold is mostly gone, replaced by digital numbers on a screen. When you deposit money into a bank, it doesn't get sealed in a box with your name on it. The bank only keeps a fraction of it. That's the fractional reserve. The rest of it gets loaned out. Let's make this real. Say you deposit $1,000 into your bank account. If the reserve requirement is 10%, the bank keeps $100 on hand. The other $900 is loaned out to someone else, maybe to buy a car, start a business, or pay for college. But that $900 doesn't just disappear. It gets deposited into another bank. That bank then keeps 10%, $90, and loans out the remaining $810. That money is deposited again, loaned again. And this process repeats over and over. Through nothing more than lending and redepositing, your original $1,000 quietly ends up supporting close to $10,000 of money circulating through the economy. There's no printing press, no mint. It's just trust, accounting, and confidence. This is one of the most misunderstood facts in all of economics. Banks don't just move money around. They create it. For some people, this realization is deeply unsettling. It sounds like a magic trick, or worse, a carefully managed illusion. Critics argue that fractional reserve banking creates money out of thin air, backed by nothing more than faith. And you know what? In a way, they're right. The system only works because we all believe it works. As long as we trust that banks will give us our money back when we ask for it, everything runs smoothly. Withdrawals are predictable, loans get repaid, and confidence builds on itself. But when that trust cracks, panic rushes in to fill the void. History gives us some pretty stark warnings. During the Great Depression, fear spread faster than facts. Rumors of a bank being in trouble were enough to send huge crowds rushing to withdraw all their savings. But the banks couldn't meet the demand. Not because they were dishonest, but because the money was already out in the world, having been loaned out. Thousands of banks collapsed. Lifetimes of savings vanished overnight. The lesson was brutal. This system is only stable as long as confidence survives. In response, governments had to reshape the entire system. Central banks were given the power to act as a lender of last resort, able to create money instantly to support a failing bank. Deposit insurance came next, guaranteeing that regular people wouldn't lose everything if their bank failed. These protections weren't really designed to eliminate risk. They were designed to prevent panic, because panic is the true enemy of fractional reserve banking. When confidence holds, the system fuels incredible growth. Businesses get the capital they need to expand. Homes get built. Roads and bridges are constructed. Innovation accelerates. Money doesn't just sit idle, it moves, it multiplies, and it powers entire economies. But the same mechanism that creates all this opportunity also magnifies danger. When banks lend too aggressively, bubbles can form in the economy. And when those bubbles burst, the damage spreads far beyond the world of finance. The 2008 financial crisis showed us just how fragile that trust can be. Mortgage loans were bundled together, multiplied, and sold all over the world. When borrowers started to default on those loans, faith evaporated almost instantly. Banks stopped trusting each other. Credit froze solid. And once again, governments had to step in, not just to save the banks, but to save belief in the system itself. So fractional reserve banking isn't a scam, but it's not a miracle either. It's a tool, a powerful, delicate tool. Like fire, it can warm a home, or it can burn it to the ground. And here's the final twist. Your money has value not because it sits safely behind steel doors, but because everyone agrees it does. Because you trust the bank. The bank trusts its borrowers. The borrowers trust the economy. And the economy trusts that tomorrow will be similar enough to today for everything to keep going. Every time you swipe a card, make a digital transfer, or deposit a paycheck without a second thought, you are casting a silent vote of confidence in a system most of us never even see. So the next time you imagine your money resting peacefully in a vault, remember the truth. Your money isn't sleeping. It's out there, moving, multiplying, and working, held together by one of the most powerful and fragile agreements humanity has ever made. Thanks for watching. If you found this interesting, don't forget to like and subscribe for more. See you next time.